Welcome back to Inflation Decoded and Explained. Is buy and hold for your equity investments a good strategy for an inflationary period or not? That's what we're gonna look into today. Now, I give it away already. Buy and hold was actually a terrible strategy if you look back in the past, in the 1970s. And I will explain why, and I also will explain why Warren Buffett actually did incredibly well during that period. But first of all, let's keep in mind, no one knows the future. Why? It's very simple. The future is the result of today's decision making. Decision making by politicians, by central bankers, by business leaders, and by people like you. And collectively, they determine the future and they determine what the stock market is gonna do. And don't underestimate, during crazy times like inflation, there's a lot of irrational decision making. So we never totally are able to predict the future, but we can anticipate certain scenarios and we can look into the past and apply critical thinking and see what can we learn that helps us today to make better decisions. And exactly this is what we're gonna do. So let's start. The 1970s inflation period was roughly between 1973 and 1982. There were two big peaks. Both peaks, first one around 74, both peaks led to incredible central banking action. 780 basis points federal funds rate increase during 73 and 74 inflation shock. And then later, even more, 1700 basis points increase, 77 to early 80s. That was tremendous. That was a time, by the way, when the federal funds rate in the US was above 20%. So not surprisingly, after both peaks, we had severe recessions. And they didn't do well for the stock market, but we get to this in a moment. So, the 1970s inflation crisis, keep in mind, two peaks, quite volatile. And both peaks led to severe recessions. What did the equity markets do? Well, here's the equity performance between 1973 and 1982. That's kind of like the period that we refer to as the 1970s inflation crisis. Now, first of all, it's important that we always look at relative performance. The absolute performance, particularly during times of inflation, doesn't count that much. What you want is, you want to beat inflation. And accumulated inflation was 130%. So whatever your investment was, you have to make 130% return to beat inflation. And then you're break even, you haven't gained anything. Also keep in mind, this is pre-tax. On absolute gains, you pay taxes, even if you didn't beat inflation. So what happened back then? If you look at the S&P 500, including dividends, over that almost 10-year period, it didn't beat inflation. It was if you were a buy and hold investor, it was a terrible time. You lost tremendous purchasing power back then. So you lost money, even though you made an absolute return of roughly 90%, but before taxes, right? But you should have made 130% so you can buy the same amount of goods with your investments. So the S&P 500, a well-diversified index, did not help you. But what's interesting is Berkshire Hathaway, the company from Warren Buffett, did incredibly well during inflation. 894% return for the shareholders. That is amazing. And what did Warren Buffett do? He did not do buy and hold. And we're gonna look into this into more detail now. So first of all, let's just explain one thing. In 73, 74, right at the beginning of the inflation period, everybody was caught on the wrong foot. And that's why the S&P 500 within roughly 1.5 years lost 50% of its value. This is an incredible loss of value. So when you look at this performance, that explains already why the S&P 500 was so far behind. Later there was a second inflation shock. People were more comfortable with inflation and how to fight it and deal with it. So the performance was better. But again, the stock market did not beat inflation. So what did Warren Buffett do? Well, we have to come back to my 4 phases inflation management model, which I have explained several times in previous videos. Or if you want to have a detailed explanation, read my book. Came out in 2016, where I predicted a big inflation crisis for today's world. And it has this model, which I use to consult with big companies and prepare them for inflation. So, what you have to understand before we move to Warren Buffett is the following important insight. There are 4 phases in an inflation cycle. And for each phase, you have to have a different strategy. Simply because the environment is totally different. So, in the first phase, pre-inflation period, the world is great. Interest rates are low, going lower, economic growth is great, credit is available, corporate earnings go up, unemployment rates are low, and business readiness to invest is pretty high. It's a paradise, right? Then comes the inflation shock and everything turns around. After the inflation shock, there's a plateau. And then comes the period of disinflation and normalization. That's when inflation goes back to the normal period. That was basically at 82, 83. Now the interesting thing is that Warren Buffett seemed to have known pretty much how this inflation cycle works out. And for each phase you can say he had different strategies. So here in the pre-inflation period, you might remember in the early 70s, he sold down his equity exposure. In the inflation shock, when stock market went down, he was excited to buy stocks cheap. Then later at the plateau, when interest rates were high, he, for example, went into bonds again, long-term government bonds. And that was a great strategy because as interest rates went down the next 10, 15 years, he had an incredible return on these investments. So that was the strategy that Warren Buffett did. He was looking at each phase and making completely different strategies. One thing I should mention with Warren Buffett, he went into this phase, the inflation shock, with lots of cash. You always hear today, cash is trash or cash is bad in inflation. Well, if you have an inflation shock like 73 or 74, when bond markets crash and when stock markets lose half of their value, you're happy when you have cash. And you can deal with a few percentage points loss in purchasing value. But if you lose 50%, that's traumatic. I should mention at the end of this session that once an inflation period is over, the world can change very quickly. And that's on the chart that I have here. This was the end of the inflation cycle, June 30th, 1982. And then 1.5 years later, the S&P 500 went already up 50%. So you could argue, coming to the end of this presentation, well, buy and hold is actually over the long time not that bad, because if you set out these losses initially and then got these uplifts, it was okay. However, Warren Buffett clearly showed if you have a sophisticated inflation targeted strategy, that's the way to go. It's more risk, but you saw his return for shareholders. I hope you like this video. Subscribe to my channel if you like it. And any questions, shoot me an email or put them in the comment section. Thank you very much.